Now we've reached the final step of the EYES short accounting series, which is financial reporting. This is where all the work we've done so far comes together and turns into useful information. Reporting comes only after everything else is done. We first choose the accounting system, set up accounts, record all transactions, and then review and reconcile the numbers. Only once we are confident the data is correct do we move to reporting. Financial reporting is simply the process of summarizing all accounting transactions into clear reports. Instead of looking at thousands of entries, we use reports to understand what happened in the business during a period. This includes checking how much the business earned, what it owns and owes, and its cash position. These are also the financial statements, which we will further discuss in the upcoming slides. There are three main financial reports that you should understand. Each one tells a different story about the business, and together they give a complete picture. The profit and loss statement shows the performance of the business, but not necessarily the actual cash received. The balance sheet shows the financial strength of the business, including its assets and its ability to handle loans. And finally, the cash flow statement shows how cash moves in and out of the business and how the organization is using its money. The profit and loss statement, or it's sometimes called income statement, shows how the business performed over a period of time. It compares income earned with expenses incurred and tells us whether the business made a profit or a loss. This report shows the business performance in terms of product or service provided during the period and not just cash. The balance sheet shows the financial position of the business at a specific point in time. It tells us what the business owns, what it owes, and what belongs to the owners. Think of it as a snapshot taken on a specific date. Its purpose is mainly for seeing the financial strength of the business and whether it can stay solvent or not. The cash flow statement focuses only on cash movements. It shows how cash came in and went out during the period. This is important because a business can be profitable but still run into cash problems. Another way to look at it is to see how the company is utilizing their cash. Are they handling their operating activities' cash flows properly? How much are they investing of the money, how much loans they are taking, and how much dividends they are paying their investors. In real-life practice, once the data has been reviewed and reconciled, generating reports is straightforward. You select the period, choose the report, and the system generates it automatically. If the data is correct, the reports can be trusted and shared with underlying parties. These reports are used by management, owners, auditors, and sometimes regulators. They help answer basic questions like, are we making money? Do we have enough cash? And what do we owe? That's why accurate reporting is so important. At this stage, the accounting cycle is complete. We've gone from recording transactions to producing reports that help people make decisions. Reporting is where accounting becomes useful. Good financial reports depend on good bookkeeping and strong review processes. When everything is done correctly, reports become a powerful tool for understanding and managing a business. Thank you for listening to this series, and let me know if there is any specific topic you want us to go in details on.